Bitcoin and gold have both stalled as the market holds its breath for rate cuts this week, which seem to be almost guaranteed. A lot of people think that when these rate cuts come, everything is about to soar to a new all-time high. We're going to discuss everything happening in the macro and with Bitcoin today on Macro Monday. Let's go.
Let's go.
Happy rate cut week to those who celebrate. It seems like a foregone conclusion that the Fed will finally give Trump exactly what he wants and the people what they want, which is looser liquidity and rate cut cycle starting. We're going to unpack all of that, of course, today. And guys, I've got some other good news. I just put in the call to the editors to give us our own intro video and music, especially for Macro Monday.
Oh, cool.
I don't know what it's going to be, but you're all going to be in it, and it's going to be amazing.
Honored. Thanks for having me on.
I think people are just sick of hearing that same song every single day. Okay, listen, let's dig in. We know what's coming this week, right? I mean, we're getting rate cuts. It would seem like basically a foregone conclusion. We have the CME FedWatch putting it at 94.2% odds that it happens at the September 17th meeting. Mike, I'm sure in the morning meeting, you guys were digging into this.
Yes, well, I enjoy you going there and starting there, Scott, because the headline I started to prepare for tomorrow is, it's easy. Fed's cutting rates, stocks go up. I mean, that's like death and taxes. It's done deal, it's accepted. And that's what I'll skip over to what Michael Casper mentioned. He's equity strategy. He said it's unusual for the Fed to be cutting at the top of an equity market. I don't think he even expects the top, but that's point. He still pointed out how expensive stocks are versus bonds, earning yield versus 10-year, sign of slowing of equity returns. He's watching retail sales closely, but obviously still quite the bull market. Oh, speaking over to Anna, she mentioned some unique things. Seeing what happens with retail sales, expect them to drop a little bit, 0.2% versus last month's 0.5%. Key thing she mentioned twice was the wealth effect. And it's good to start hearing people saying, I'd like to hear the Fed start saying what's actually going on in the market. It's the wealth effect, but come on, it's overwhelming. But she did make some key points. Is typically there's some, what she pointed out is the dissents, not everybody votes, but the dissents can be, the dot plots can be quite dissents. He said last time there were 7 in the last FOMC who did not expect rates to go down, and so their dissent showed their dot plots showed dissent. She expects to be at least 5. Actually, obviously, Steve Moran this time is going to show probably easing or vote for easing, but she expects dissent still show 5. So it's not just Powell. I love how President Trump pointed him and now is pissed at him because he's being a good economist or doing what he views. But, Dave will touch on that one, I'm sure. But so Ira Jersey from the pointed out that he expects the steepener to continue. He's looking at key technical levels, 30-year, 3.6%. That's my baby. That's why I started in the trading bits. I think it's a key indicator. But right now, 3.66, that's a key support. And 10-year note, he mentioned 4.4% is really doesn't really matter. What really holds over time is 393. Expects the curve to continue steepening. And then I tilt Audrey Child-Freeman, our FX strategist, points weakness in the dollar. She made a point I thought was interesting. The consensus is for a 25 basis point cut. But we do, and Anna does expect the Fed to be less dovish than the market expects.
I agree with that.
And that, yeah, there you go. So the dollar's probably going to bounce on that. And then I tilted over to my macros. I don't know what stops gold. And I tease them about everything I heard from them. To me, means buy gold, but that's just, hearing what they're not saying. I point out 3,500 good support. Next resistance, I think, round number is 4,000. And I dug into the positions. I still am radar on what, you're looking for on a good bull market, you want to show positions way overextended, and they're the opposite. Managed money net positions are well below last year's peak. That was around 50% of open interest in futures. Now it's only about a third, 33%. And ETFs, yeah, they're picking up. But if you look at them on a basis since the end of 2008, they led all the way up. And since 2004, 2024, they've been lagging. So those two signals are show we're not overbought in gold. So I expect that to continue. Opposite in crude oil. Here's a key little thing about crude oil is looking at positions. Right now, net long is around 7% of open interest. A year ago was when the first time ever they got net short. Remember we talked about that? Crude oil bottomed at 65. And here we are, we're below that level. It's 63. Positions are long. What's the risk? Yeah, we probably have stop out risk. There you go. Well, détente, definitely. Peace is at risk, which is probably a problem for gold. So I point out those key factors. And then the other markets, copper stuck in the middle. Here's the key thing I mentioned on the copper. Dr. Copper, the economic sensitive metal, right now is at 466. It's never ended the year above 446. Can it do it this year with the world facing downtrends and U.S. tariffs? I think it's unlikely. So I've been waiting for that one for a while. I think the peak this year was like crude oil. I mentioned that last time, and it could go lower. And then I look at the rest of the grains in terms of commodities. They're still heading lower. Too much supply. Back to you.
If I was a betting man, I would say that we get what we'll call hawkish cut this week.
There you go.
Which is that Powell will cut 25 basis points, then say no commitment towards further cuts. We're going to be data driven. We're watching tariffs closely, blah, 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 blah. It'll be the most non-committal rate cut in history just to confuse people as much as humanly possible.
Well, but if you follow the blueprint, sorry, can you hear me, Scott?
Yeah, I can. James was muted. I could see him talking.
Oh, sorry. James here.
James, I think you got to work on your mic. We can't hear you. Go ahead, Dave.
Yeah, while James gets the technical difficulty sorted, I was going to say that, the blueprint that we talked about last week is cut, no cut, whatever happens. The total direction of the market's going to come from the presser. And if in fact he is that non-committal and he is that hawkish, then it'll kind of be a crappy week for risk assets, or at least a crappy day or two. Until the pounding and the war drums start beating again, et cetera, et cetera. I mean, which I find kind of amusing because whatever Powell says, we kind of know where things are going to go. It just, it's a question of time. So, depending on how long-term you are, it's fascinating. There's just a lot to talk about there. The one point I wanted to make about copper that Mike said is, when you use words like never close above a certain absolute dollar level, and there's double the number of dollars that exist today that existed, 10 years ago, actually 5 years ago, what you're basically saying is right now, if you adjust for the number of dollars in circulation, it's really interesting. It's an interesting question. I'm not so sure that copper is all that high. It's that there's just a lot more dollars. Basic economics. And it's extremely important to look at it that way, because it's the same thing with crude. The real thing to keep an eye on is copper's price versus copper's production cost, just like you always do with crude oil versus crude oil production cost. And I think that's very relevant. And I'll be blunt, I have no clue what copper's production cost is right now, so I don't know what to say about it. But I do think that looking at charts and not taking into account the fact that we've literally doubled the number of the money supply over the last 5 or 6 years is problematic. It leads to kind of strange analysis.
Yeah, well, across the board on all of it. But
I appreciate that. Just let me mention one thing on that, James, and you go. I'm really glad you went there, Dave, because our audience needs to understand the deflationary forces in commodities. And the reason I don't go there, because by inherent nature, commodities are deflating assets. We create more with less every day. And just the fact that crude oil is the same price right now as first traded in 2005 shows you that overwhelming deflating force. Because what's happened with money supply and stock market inflation since that time? That's the key thing I always like to bring out. And there's only one main commodity that doesn't deflate. It's gold. Everything else, we create more with less. I just come from the Corn Belt. I mean, compared to 50 years ago, 1 acre of land is double the yield it was 50 years ago. So that's the key thing to remember. And I'm glad you mentioned, but it's just when you're a commodity trader, it's just inherent and that's the way it is. And I just look at the price of corn right now. It was first traded in 1974. Yeah, that was a spike, but that's how they work. And I'll end with this. Commodities go down because they went up. And that's just trajectory in almost every commodity except gold, and copper's kind of stuck in there. And it's just where we are right now. We're going down because that spike in 2022 and most of the elastic commodities. So that's the key thing. But I think I'm glad you went there. It's just a key thing. Remember,
it's why I always focus on consumer versus asset inflation.
Right.
Technology does not have a deflationary impact on assets. It absolutely has a deflationary impact on stuff we consume. And with AI, it might even have a deflationary impact on services, which is something that the world is not ready for. But there's a lot to go for there, and there's a lot to unpack. But James was going to start on something, so rather than ramble.
It's the classic, it's the classic kind of philosophical argument of the Fed is the arsonist that has been now in charge with putting out the fire, and they know it. And so you talked about the wealth effect. They caused the wealth effect. They know that. So now they're stuck. The Fed doesn't care about the stock market, right? They don't care about it. They say it all over. We are not, that's not our concern. We're not concerned with where the stock market is, unless, of course, because the United States is so financialized that we have to do something to produce more liquidity in order to keep the market afloat, because if the market crashes, then the whole economy crashes. So we know that they are now caught in an absolute awful position. We can all see the jobs are sliding. We're watching it happen in real time. We revised out almost 1 million jobs from last year, and that only goes through March. Who knows what the job numbers really are, right? I mean, the BLS is obviously that information they have is just not accurate. And it's lagging, and it gets revised over and over again, as we talked about the last couple of shows. But the Fed is now sitting here. They're going to say, yeah, we've got to cut 25 basis points because we have air cover too. We don't want to, but we have to because we have air cover too, and we will have financial revolt, and that could cause the market to slide lower. Which again, they're just trying to keep it balanced. They don't want it to crash, right? They don't really, they say they don't care, but they do care enough that they don't want it to crash. They don't want to cause something that do something that cause a crash. Now, getting to Dave and Scott's point of what's Powell going to do? Well, I think he is going to be very tempered in his delivery. He's going to be extremely careful about how dovish he sounds. So he may come off a little bit hawkish. That's right. And so the market is expecting one full rate cut. Some people are expecting that it could be 50 basis points. Are making that bet. It's not. I don't think it's going to happen.
Powell would panic the market if he did that.
Yeah, I think that would be the wrong. That would be the wrong message. It would be like, we see something the market doesn't.
Broken.
See.
That's what he would be saying.
And that would send people reeling. The market likes that. It just doesn't like uncertainty. That's exactly right, Scott. I agree with you 100%. It doesn't like uncertainty, and so Powell's job here is to cut by 25 basis points and keep it tempered. But what I don't think he should do is say, we're going to cut 25 basis points, then we are firmly on hold status. Then we're just going to stop. I think that would be a mistake too. I think he has to continue to say that we're data dependent, because the data is coming in worse and worse on every single measure except for one, which is inflation. And that's the fire they caused, that they're worried that they've got to put out, but they can't. They don't have the lever to put that out except for QT. If they use QT to put it out, it makes the job situation worse. So they've got two mandates. They've got the stable pricing mandate, 2% inflation, whatever that means. And then they've got the full employment mandate, which there is no measure for that except just not too many people who are jobless. So yeah, I fully expect 3 rate cuts this year.
Right. Interesting though. Here, James, I just want to show you something while you're talking. Morgan Stanley and Deutsche Bank expect 3 U.S. interest cuts this year, and then you have UBS saying 93% of a recession.
Wow,
that's an aggressive number. I feel like that's clickbait headline, but still.
Yeah.
Look, you have to understand. And one
economist, but you say
one guy at UBS,
one guy at Bank of America that's saying it. Yeah.
Look, we obsess about the short-term rates, which is kind of wrong, but you have to look at the cross currents that are going on here. I mean, the chart that Robert put up that we were going to talk about, I think is extremely important here.
Okay, let's go there.
Why don't we put this up? Because
I got it.
So Robert made this post. See if you can blow that one up.
Yep.
You got it. Okay. So this to me is maybe one of the most important, interesting charts I've seen in a very long time. So if you look, the purple line and the blue line. The blue line is what Mike talks about all the time. And frankly, until I saw this chart, it worried me a lot. It still worries me. There's no two ways about it. When the S&P divided by our gross domestic product is at all-time highs, that is worrisome. It always is. But what's fascinating is corporate profits have moved up in line with that, meaning that okay, so there's some valuation issues here. I still think we're at the top end of valuations, but at least you could kind of understand it. But what is fascinating is at the exact same time that's happening, total income and wages as a fraction of GDP have been falling. So what you're seeing, this chart shows more than anything that we've ever seen, the financialization of the economy, and it shows the bind the Fed is in. Because when they cut rates, what does it do? It pumps assets. It pumps the purple line and the blue line. What does it do for income and wages? Well, arguably, it allows more investment in things such as outsourcing and automation, which pushes the white line down. But it does create jobs in the short term when that's happening, which is what they're obsessing about. And so this chart shows what the easy money policy has done over the last 25 years. But the question is, can they afford to be not, hard money, because it isn't. They're still pumping liquidity into the economy, but can they afford to keep setting the price of money artificially high? And when I say artificially high, I literally mean artificially high. I mean, our rates are higher than most of the rest of the world for lots of reasons. You can't find rhyme or reason out of it other than people will argue, and Mike and I can talk about, well, it's because the dollar is reserve currency. But as Mike points out constantly, the rates in every other country, except for maybe the UK, which is a dumpster fire, are lower, much lower, right? I mean, hell, why should Italy have 10-year borrowing rates or France, given what's going on there, have 10-year borrowing rates that are significantly cheaper than the United States? I mean, if you could objectively explain that to me, then I'll learn something, because I certainly don't understand it.
Yeah, quickly, Dave, for those, I don't want to take for granted, there's people who don't see the chart who listen to this, probably more than actually watch it, believe it or not, on Spotify and such. Very obvious chart, because it's important. You have income and wages versus GDP going way down, while corporate profits and stocks go up.
Right. And so, this is the kind of thing that people like Thomas Piketty would point to and say, or Zoran Mamdani, oh, you see, this is the evil corporatists. Well, no, it's nothing to do with the evil corporatists. This is to do with the fact that we have made the price of money way too cheap for way too long, and we have financialized the economy. And when you financialize the economy, this is virtually guaranteed to happen. Doesn't mean that jobs haven't been created. Doesn't mean, whatever. But, these are the forces that are operating, that Mike talks about commodities, that are working on labor as well. Okay. As labor gets more and more productive, you pay people less.
Okay, so Mike, obviously you have a response to this, but the point here, for those if you didn't read Dave's tweet, he said, this is why the stock market isn't nearly as overvalued as my friend Mike McGlone thinks. He obviously pointed right to you in this tweet. So we're the opportunity for you to have a response, because you do point out every single week and all the time, very rightfully, that this is the most overpriced the stock market's effectively ever been. So Dave's saying it may be, but still not as overvalued as you think.
So, but it's very important that we push back on each other, because it helps our hone our views in our discourse. So part of the reason I've added into the U.S. stock market valuation versus the rest of the world is to offset sort of that factor that Dave points out. Oh, yes, we financialize, agreed, versus GDP, agreed. But Trump always legitimizes is when he says he wants Europe to spend 4 to 5% of the GDPs on defense. I'm like, okay, well, that kind of legitimizes GDP above denominator. But I want to show you one key thing as a strategist I'm still very much concerned about. And I can show you, if you can share that screen, Mike, yep, that would be great. And that's Misha. Is the thing that's when I enjoy, and it's kind of my duty sometimes to agitate, to be an antagonist. When people say how easy is for the stock market when the Fed eases to go up, I say, well, okay, well, how about versus gold? So all I show you here is gold. This is the S&P 500 versus gold ratio. It's breaking down through a key pivot. This is a pivot at 1.94 ounces. It's been a key pivot since, I remember trading it before in 2007, and then it held resistance forever, and it just broke down this year from this level. But on the same scale as Fed funds, every time Fed funds really go down, stock market goes down versus gold, typically. And, obviously it's not perfect. It's only 30 years, but this is what, like, gold is leading the way here. That's why I'm so concerned what's happening in the gold market. And then I look over at positions. I'm sorry, shoot, I don't see
You can say
positions
shit,
getting overdone, but yeah, well, I hope my mother's not listening. But other way,
I know she might hear Dave. She might hear Dave if she's
Mom.
listening.
Oh, that wouldn't be good. I may be NSW
Yeah, if she's listening,
in
you're
a certain
good.
age
But-
category.
And then I tilt over to the U.S. bond market. Yes, and this is just the average U.S. Let's say 4.03 in the U.S. 10-year. Obviously, it's somewhat restrictive versus, okay, we have core PC at 3% and some levels below that, but they're all, going to tilt lower. It's the wealth effect. But just look at the rest of the world, like you mentioned, Italy, 3.48. I always love South Korea, because it was pretty close. Now South Korea's broken down. Obviously, they're facing tariffs. And then there's China, 1.79. Then there's Japan, 1.5. I mean, these are 1 and 2 handles, and only a few rare ones in this. So it's just, to me, Canada's running 7% unemployment. Yes, they're typically a little bit higher than U.S., but not that much. Their latest unemployment number was, 40 to 30,000 losses. That's the same in the U.S. is between 300 and 400,000. So to me, this is a key thing, is what triggers that. And I think we're at that cusp, and that's why I think the next few months are going to be great for trading. But if things are tilting lower, that will be a setup for a pretty normal correction. Those of us have been waiting for a few years, and I am so impressed. We got into 15 minutes in this conversation, haven't mentioned what's the word? Bitcoin or cryptos?
Yeah.
Well, I was going to mention. I was actually going to say that understanding one point, because we talked about it, which is the reason that you can talk about copper and absolute levels with the dollar dollar being created, is because we get less is more, right? You can create more supply. In Bitcoin, you can't. And that becomes, and by the way, you can't in gold either, really. We've kind of reached the peak of gold extraction technology. So they're similar.
Bro.
There you go. Asteroids.
Well,
No problem.
okay, fine. I'm sorry. I forgot about alchemy and asteroids. Okay.
Takes another hit. Asteroids.
There you go.
Yeah, it's and what does it cost for a typical launch to and from an asteroid? No problem
come on,
measuring
Mike.
that.
Well,
Stop
if you
being
get
rational.
$1 quadrillion worth of gold out of an asteroid, it would be worth it. But
Depends.
All right,
It depends. It depends, Mike. Is it SpaceX or is it the
SpaceX.
US
That's right.
government?
Who's doing it?
yeah, we could talk about all of that stuff, and it would be just like the complete cesspool that all social media has turned into over the last week in terms of conspiracy theories. Or we could stake with our feet on the ground, which I'd prefer to. I think a really important. There are two other topics I wanted to bring up. One relates to James's newsletter directly, and one is indirect. Right. So James, I'm teeing you up here. So interesting news out of the UK, which is completely insane. But then again, I think that the UK government, I keep calling them a dumpster fire. I mean, they are struggling in quicksand. Now they're talking about capping the amount of stable coins people can hold, because somehow stable coins, which are fully reserve backed and have no fractional reserve banking, are risky. Now, the reason it ties to James's newsletter is that there's this fear that the banking industry keeps telling people. I don't understand why anyone would listen to morons like this, but they keep telling people, well, this is like private banking, and private banking is bad. And of course, James wrote a whole newsletter this weekend about private banking. So I think it's interesting, but the UK is falling further and further behind in terms of between the Online Safety Act and now this. It's like the real question is you're in London right now, Mike. Are they really trying to destroy the city of London and push all the people to the rest of the world? Because if they were
New York,
I'm really not certain that they could do a better job if they were trying to do so intentionally. I mean, it's kind of insane.
Yeah.
So I want to just comment on that. I definitely want to hear what James thinks. I enjoyed arriving on Saturday, for there was a big protest, over 100,000 people. And I learned one quote that I was unaware of. Keir Starmer is a wanker. That's what they were saying. I was just quoting what I was hearing in the tube when I was, there's thousands of people yelling that. I'm like, oh, okay. I was not aware. At least Americans probably would have used less pleasant terms than that. But so the key thing I want to point out is that, to me, I think you're showing an example of the rest of the world with their eyes wide open, staring at what's happening now. What we picked up on years ago, the Trump administration hated first and now figured out, helped them get elected, is realizing the base layer for this most advanced technology is the buck, the dollar. So think of those other 130 other currencies on the planet. There's only 10 of them that are really as robust, near the dollar. poof, they're going away from people can access to the bulk via their phones and crypto dollars, as you know, I like to call them.
Yeah.
So to me, that's part of the technology that I completely agree with Scott Best. And what was 2 billion in 2018 is almost
Trillions.
300 billion now. It's going to go to 3 trillion. Yeah. And once we figure out how to make them more like we can get the yield on it and make a money market, it's done. It's just like futures, a better technology.
Yeah,
But
I want to go to James on the other one. I just want to show a really quick article. There's actually an article in Cointelegraph. The end game for US dollar stable coins is no tickers. That you'll just, it'll become the dollar on all of these platforms and it'll be interoperable and you won't even know which one you're using because it won't matter because stable coins will be so big. But James, yeah, there were two things I wanted to ask you specifically about. Obviously, we want to talk about your newsletter here, which is shadow banking and private credit. To that end, I tried to send you a link yesterday and just didn't, apparently. But Wisdom Tree launches tokenized private credit fund, and London Stock Exchange launches blockchain platform for private funds. All of this happening at the same time. So beyond that, you weren't even writing about crypto. This is now happening on the tokenization front. And there's one other topic after we go into this that I want to talk to you about. But go ahead and break this down because it's so important.
Yeah. So what's important about the newsletter I wrote this weekend about shadow banking is that it's all this capital that is, somewhere around a quarter of a quadrillion, so $240 trillion worth of money that's sloshing around in these what are known as the shadows, because they don't have the same oversight as regular banks do, and it's hedge funds and private equity, private funds, private debt funds, but they're non-bank institutions basically, and they touch everything. You're talking about things like Apollo and Blackstone and some of the other big ones, but the biggest part of that, the most concentrated part of that is private credit, and that's where you've got the private debt from the Apollos and Blackstones, whatever, that are lending to these companies, and the issue is that you don't really know what's going on at them. They mark them themselves. They can
high rates too, right? I mean, if you're paying 7 from a bank, you're paying 12 to these guys.
Yeah, exactly. They're higher rates and they're more predatory. I've seen, we were talking to a company, a Bitcoin company years ago about taking a loan from one of these banks and opening up a debt line with them. We said this is a loan to own. We're warning you. And sure enough, it became a loan to own. And what does that mean? It means that they made the covenant so onerous that they knew that the company was going to trip them. They were going to get a whole bunch of equity out of it, which is what they did. And so sometimes it's predatory. Sometimes they're just trying to make a bunch of fees on it and just kick the can down the road, meaning kick the maturity can down the road. And they change the terms. They move the goalpost so the company doesn't go break covenants, so they don't have to do the loan and own, and they can still mark their book appropriately and attractively in order to sell another fund. And so it's a little bit insidious. Now I'm not saying that all of the private debt funds out there are like this. They're not. They just, it's a way to operate without having the same financial regulatory oversight as the regular banks. Yeah. But it's a lot of money in there. And what we are seeing is that they do hide the default rate. But if you bring that back up, Scott, you bring up the back up and go down to that wheel, it'll show you all of this. Is a great Carlyle Group put this out. This is a great chart to show you, right there, how it touches pretty much everything in the universe. I mean, in the financial universe, it's every single aspect there is touched by private credit. And so is it super dangerous right now? No, but it's something that we don't really know about, number one. Number two, what is a red flag is what you just brought up, that headline of, they're going to tokenize these things, they're going to create funds in them, and who's that going to?
Supercharged private credit.
Yeah. The issue is that, the capital raising for these private funds, it dropped like massively this year, and they've only raised $70 billion through July, and that's the smallest amount they've raised since 2015. What does that tell you? that tells you that institutions are full up with this stuff. They can't keep buying it. So what does that mean? They need exit liquidity. You're going to start seeing, endowments, which we have started seeing endowments selling this stuff for less than 100 cents on the dollar to the mark to market to get out of them, because they're like, we need some liquidity here. We can't be sitting on these funds that keep moving the terms, and they're not a 5 to 7 year fund. Suddenly they're a 9 to 12 year, 12 to 15 year fund, and we've got to start getting liquidity out of them. So who's it going to go to? It's going to go to retail. They're going to sell them to these ETFs or whatever. However they're going to do it, they're going to create funds they're going to be accessible for retail. So the whole point of the newsletter was just be careful. You're getting a better yield, but you don't know exactly what you're getting here. It's just something you got to be aware of. And so I don't know if you want to comment on that, Dave, but that's kind of where I was coming from on it.
I'm actually going to ask you a question more than comment, because this is, I've been mulling this over ever since I read your newsletter. I mulled it over in my head. And the thing that's interesting to me is I don't see a whole lot of increased danger out of private versus banking. It's just, except for the fact that we have this distortion effect. The banks have access to somewhere around $6 to $7 trillion in trapped bank deposits, which they have, that they can offer for no interest, because the federal government gives them a subsidy. So we have the federal government subsidizing industry. We call them banks. Doesn't mean we don't pay the banks the same kind of bonuses that we pay hedge fund people, because we do. I mean, that's just fact. I mean, if you listen to Austin Campbell, who's an NYU professor who's often on Spaces with Scott and I, right? So great dude. Anyway, Austin and I have had this conversation, and this is one of those topics which is fascinating. How much of the quote private banking higher rates are because they don't have the federal government subsidizing them through deposit insurance, and is the time bomb sitting there in terms of unrealized losses worse than the unrealized losses at banks? I'm not so sure that that's true. I actually think the banks are probably worse because of the moral hazard of being backed by the Fed and being backstopped by the federal government. And I'm just curious what you think of that.
Yeah, well, just remember, it's so we're the shadow banks. This private credit gets their capital from the banks. Then they lend it to the companies. The companies, they're owned by who? The private equity firms, who then turn around. They've got banks as prime brokers. It just becomes like this circular reference, And so that's the issue it's hard to untangle that. And
well, specifically though, that is true at the money center bank level. That's true at the JP Morgan, city kind of level. That is not true.
Prime broker level. The prime
right.
broker
It's
level.
true at the big level. But the point that is, if you looked at the stablecoin debate, is the fear of people is, oh my God, you're going to hurt the community banks. And the community banks are the source of capital for all these people who can't get access to capital. Yet what you've proven, and in fact, we know it's true, is that at least in mortgages, private credit is a bigger factor in mortgages than community banks, and not by a small number. That's probably true for businesses as well these days. So it's just the whole thing.
Community banks are more, they've got a lot of CRE debt, right? So that's the big problem there.
You tell people what CRE is.
Yeah, so you've got the commercial real estate issue that we've all talked about with office buildings. Not all commercial real estate is garbage. You've got some office commercial real estate that's super upside down, pennies on the dollar kind of thing. But then the rest of, a lot of commercial real estate is, medical centers like hospitals or the medical campuses that you go on. That you've got the dentists and the different types of doctors that are all on these campuses, and small business campuses. That's typical commercial real estate. So it's not all upside down, but that's where a lot of the regional banks are focused, and on that paper.
James, there was another, this comes from what Dave was just talking about, but specifically wanted to ask you about it and everybody here as well, because when we talk about banks, U.S. banks are now sitting on $395 billion in unrealized losses as of Q2 2025. You can see this chart. We all remember Silicon Valley Bank somewhere in here, but it seems to be once again kind of accelerating off the lows. Does this mean that it's on investment securities specifically?
Yeah.
Is this? Maybe you could unpack this, because
that's long dated debt, right,
exactly.
Mike? That's what it is.
That's what I thought. This is the same situation, right?
Why do you think the U.S. has not been able to term out their debt two reasons. Because number one, they're worried about the amount of interest payments that they have. It's already over $1 trillion annually, so they can't really be paying 4 or 5% on long-term debt when they could have the chance to refinance this by using T-bills, by doing shorter-term debt and just playing chicken with the Fed. You know, and the second thing is how much demand is out there because of the issues like this, right? So that's it's kind of a two-headed monster for them right now that they're trying to work through. And for everybody saying, well, that's why the Fed's got to lower rates. They got to lower rates. Remember, please, for the love of God, the Fed does not control the long end of the curve. They do not control the 10-year, the 20-year, what a stupid bond that is, and the 30-year. You know, they don't control
pennies in 20 years. They got to get rid of them both together at the same time.
What do you do about a 30-year that ages and gets to be a 20-year? But I agree with that comment completely, James. But if they want to, they can, and they have.
Well, unless they institute yield curve control. Exactly.
Yeah.
I agree with that. But they don't control it by lowering rates. That's not what's going to get the rates down.
Not do this.
So everybody's sitting here saying, well, if the Fed lowers, I'm waiting for I've heard this so many times. And these are normal people, and I understand why they think it. I do. I get it. But they're saying the Fed's got to lower rates so that mortgage rates come down.
Yeah, I love that.
What happened when the Fed lowered rates by 50 basis points? When you know, right before the election, the 10-year went up by 50 basis points. So the difference there was a full percent of movement there, and so that's not how it works. Right?
Elizabeth Warren needs to speak to you, but and I completely agree with you. But there's one difference. So the curve is inverted. Then now it's pretty steep.
That's
so
true.
You got to, and then we know what happens. We know what happens to leverage with the leverage. Having done it, you know, obviously you want to. It's being in a steepener is negative carry. By steepener means you expect short rates to drop more than long rates, but the durations in the long end. If you want to get, you know, when you can buy zero coupons at pennies in the dollar, and at some point in 30 years they're going to go to 100, you can get some good oomph there. So to me, that's the key thing about the bond market that's waiting for. And I'm worried that that's the next big trade. And yeah, I've been wrong for 2 years, but there's one market that's why I started my job, and I've been, you know, I just have never seen this before. But that's the difference. The curve is steep now, and then it's the leverage that's going to kick in when they start cutting. That's why this period is going to be so important. Why it's so important. The stock market absolutely has to go up in the next few weeks, months, because if it doesn't go up with the Fed easing, that's a signal to buy bonds.
But if you go look back at what happens to the stock market when the Fed starts to cut, how late are they in their cutting cycle?
There you go.
Right? How late are they? How much are they lagging the economy? Like right now, if they start cutting now, we're not in recession yet. If they wait 3 months or 6 months to start cutting, it's a totally different situation. So that's the question. If they start cutting now before we're in recession, the market typically, as I've looked at, just screams right along.
Yeah, I mean, this is the chart I've showed a million times. You have the yield curve, which uninverts. Then you get a Fed pivot. This time they kind of pivoted and waited, and then you tend to get the stock market dip. So a lot of people expecting that if this drops right here, we'll finally get. By the way, the stock market has left the building on this chart, so maybe that's worth noting this time. Being different, but
very much
we do have a history of markets dropping after the big cutting, during that cutting cycle before obviously ramping back up.
So let me piggyback on that and just show two charts real quick, because that to me is so important. You can see it clearly on this chart. These red lines, this magenta lines, Fed starts cutting in 2000, and then we get to the recession. And this is, again, I'm overlaying with S&P 500 ounces of gold. You want to be long gold in when the Fed's easing, typically in a recession. Same thing here. We started this cut. I remember September 2007. Remember it well. It took a while once it kicked in, and then S&P 500 versus gold breaking down in magenta. We got the little test baby one here. The point is we should be getting that magenta line pretty soon. But one key thing I want to show you that's so different and so worrisome to me is here I show you a chart of the S&P 500 and GDP. In terms of, I knew Dave would have to do it, but it's just a total market cap and GDP. Right now, 2.3 times. But what's most significant is the most leading indicator, speculative traded assets on the planet, cryptos. This is the Bloomberg Galaxy Crypto Index in terms of ounces of gold. Right now, it's 1 ounce of gold. First reached that levels 2017. What I want to show you is now it's become, and the correlation is very high now between the stock market and BGCI. But if we narrow this back down to when we got the biggest money pump in history, it's the same chart. And that's what I'm really worried about. When we got to this last high, we're above the highest ever market cap to GDP. Well, you got to go back 100 years. Yet this crypto in this versus gold is lagging significantly. So what are we going to happen? Crypto is going to pick up versus GDP, or we're going to get this to just drop. That to me is the key thing. Is if this drops, that's your deflationary trend, and you get that 1 ounce of gold to be a half an ounce of gold to equal the S&P 500. I'm sorry, to equal the Bloomberg Galaxy Crypto Index. Right now, it's the same as an ounce of gold.
So look, there's so much to unpack in all this. You know,
I knew that would fire you up, Dave.
This. Well, no, because I was going to talk about the macro side stuff first, which is, let's just go straight to respond to that one.
Okay.
Because Bitcoin
can I share this screen first? Because this is really important.
Please.
And I think that our listeners got to think about this too. Okay. This is just something that keeps weighing on me. And this is the S&P 500 versus the S&P 500 equal weighted. This is really important. We have an extremely top heavy S&P 500 right now. We've got that Mag 7 that is absolutely off the charts bubble territory because of AI. And that's just reality. And then if you look at the S&P 500 equal weighted, it's a different story. I mean, look at that divergence there. That's significant. You know, I mean, that's on the 5 year, you know. If we go to, let's say, 10 years, it's even worse. I mean, so this is just something that's important to think about, Mike, when we talk about just how much the market has gotten ahead of itself. Let's talk about how much 7 stocks have gotten ahead of themselves. I mean,
and that totally backs up where I was going on the whole the use of the Bitcoin, you know, the Galaxy Bloomberg Crypto Index. Bitcoin is a huge piece of it, but Bitcoin is very, very different than the rest of the cryptosphere. The rest of the cryptosphere we always talk about on Crypto Town Hall, etc., alt season, this stuff. Basically, everything other than Bitcoin is trading like the Mag 7. It's trade, you know, as an aggregate. I'm not talking about, it's not 21 million. There's only probably 15 or 20 constituents that really matter, you know, in that index and in crypto. And those are trading like tech stocks. And whether it's crypto or AI or crypto, you know, whatever, they are inextricably linked in investors' minds. And so that piece of it, so that 40 some odd % of that index are going to trade like the Mag 7. Bitcoin is going to trade on a lag to gold, but it is they are completely different investment theses. Yes, they are bound together. And so when you look at averages, you have to disassociate the two. You have to unconflate them and look at what you're talking about. And so, yeah, there is a very real possibility that risk assets could get kneecapped because they're way too high. But the one point I was going to make, when you said that they have to keep going up, that the stock market has to go up, I actually don't think the stock market has to go up. I think the stock market has to not go down sharply. I think that's what the Fed really cares about. I don't think that the Fed certainly would prefer, if you asked Powell and he, you know, what would he prefer from an economic point of view? He'd prefer the stock market to be flat for a couple of years. I think that would be their preferred outcome. Their preferred outcome would not be it to rise 10, 15% a year with the Mag 7 outperforming. That they hate. And they would prefer not to see a 25% crash in the market, which would cause people jumping off of buildings. You know, they would prefer that not to happen because that would crush the wealth effect. They would prefer it to stay where it is and let GDP and everything else catch up to it. That's what they would prefer. Are they going to get that? I mean, they always talk about soft landings. That's what they really want. They want Main Street, which is probably already lagging Wall Street by a lot based on the chart we showed before, you know, to do better. And they want Wall Street not to collapse because that would hurt Main Street. That would hurt spending because so many people are spending off of their 401ks and their assets. That's that wealth effect you're talking about. So it's really all blended together if you think about it. Now, all of that, what does that leave in investors? Well, investors are looking, there's this pile of money out there. Rates are coming down. You could either stretch for yield by buying private credit with increasing default rates, or you could stretch for yield by buying, buying more risky assets, or you could park it in Bitcoin. I personally think the latter is the more, frankly, more prudent and better risk reward bet out there. But that's a completely separate thing from how it's going to trade, because I don't know how it's going to trade over the next month and a half. I think that it's a fascinating situation because of all these cross currents. I mean, I'm sure you agree with that rough assessment, James, right?
Yeah, I fully do. And I mean, it's really hard to say what the next few months are going to bring, because we don't know exactly we don't know how sharply the job market really is falling off. We think it's falling off, kind of in a metered fashion, but we could wake up in 8 weeks and have a completely different employment picture. We just don't know. And that's part of the challenge for the Fed. And again, look, Dave, you and I have talked about this ad nauseum, is they will wait and 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 wait, because they know that they can come at the market with a money bazooka. And they for some reason, the Fed thinks they can control inflation from that side. It's a little bit diabolic, but that's what they're doing. That's what they're going to wait and do. And maybe it's a little bit political, I don't know, but that's where they are. Yeah.
Back to the beginning of the conversation then, because everybody's obviously watching the Fed this week and Powell. What if he says we're cutting 25 bips and it's because of an extremely weak job market and we're concerned about jobs? All cuts are not created equal, right? So if you're cutting because it's fine to cut and we don't need to be tight, great, markets go up. But if you say something's breaking and we're worried and
it's different. There's a difference between him. Yeah, there's a difference between him saying we're cutting because we want to get we're far enough above the neutral rate that we think we should get closer to it. That's a different thing than we're cutting because we have concern of the job market. Whoa. That's a completely different thing. If he says that, then they better cut 50 basis points, right?
Right, but there's no. So, Mike, I mean, that's why you kind of joke about the consensus. We get a cut, everything goes up, yay, right? I mean, we have a history of cuts not being great. Why is there so much certainty that everything will go up? Also, when everything's already gone up in anticipation of the cuts.
It's the analysis of human nature that I've always loved in markets. That's a great way to make peaks. When we all agree on something, we all remember it. You remember 2006 when everybody agreed, the U.S. housing market's never gone down on an annual basis in history. Well, it wasn't true, but it did happen. I remember even Greenspan was somewhat messed up by it, but I remember getting way short, way too early markets, and just knowing that, people are focusing on something. It's human nature to repeat statistics that basically are not true, to make you feel about levels that are just historically where you shouldn't be overweight long risk assets. That's the point I've been making about cryptos and Bitcoin at this level. And I just want to point out
the market can stay irrational far longer than
of course.
Stay liquid.
Right? But that's my point, is at the beginning of the year, I still have this bias, and it should be overweight positions. The best positions this year should be overweight gold and long bonds, and I stick with it. And just an equal weight position of those, I'll be outperforming virtually all risk assets with half the risk. The fact that we're already 9 months into the year and we still have a record-setting stock market, despite a record-setting stock market, makes me really concerned when we stop having record-setting stock market. I didn't say if; it's just a matter of time.
And it's also a matter of what makes it go down. Is it just a grind lower because of the economy, or is there a black swan event? Yeah. And so that's the big question. And then the next big question is, what's the Fed's response? You believe that the Fed has learned its lesson. I do not believe there's a lesson to be learned. I believe, I'm sorry, I don't want to put words in your mouth, but you have said that before. They've learned their lessons of the past, but I believe that it's not a question whether or not they learn the lessons. It's a question about whether the terminal patient is going to now not be given any more drugs to stay alive.
So what I'm expecting is a long-term period of the Fed cutting rates and following the stock market and wealth effect reversion. I didn't say down, just reverting a little bit. But to do what we did in 2008 and 9, pumping too much liquidity in the system, and do again what we did in 2020 and 21, pumping too much liquidity in the system. I mean, that shifted the election cycle, the inflation. That's what was a key thing in the election cycle, was inflation. So I think that's my point, is at some point, this is the lose-lose that gold, I think, is figuring out.
Well, I mean, that's the other thing. You've got two paths. You've got the stock market going to all-time highs and gold going to all-time highs. It just doesn't make sense, right? So
well,
you've got two different trades going on.
But it does. We're
inflation
printing more. We're printing more dollars. All assets have to go up, and gold is outperforming because it's a purer play, and stocks your chart,
and that is the point. That's the
your
point.
chart that you showed
yeah.
is exactly right. The companies that are not tethered to earnings because they're based on stories. I mean, OpenAI, it isn't even part of the Mag 7, having losses as far as the eye could see. I mean, they're not going to generate a penny of cash until 2029, and they're worth what, trillion? Worth $1 trillion in the private market. That's not a story. Of course, it's a story. The Mag 7 are up because of potential future earnings in the next decade based upon some technological story. So they're not tethered to earnings and whatnot. Gold is basically a pure play on the debasement of the currency. But when the denominator moves, everything moves. And what's going to move most? It's going to move most of the things that are based on animal spirits and stories. So yeah, it is actually consistent. I mean,
it is consistent now, but in that's the point, is that we're printing at a rate now that people are looking for ways to avoid having their debasing of their investments.
That's right.
That's all they're doing. They're taking money out of the money markets. There is no reverse repo anymore. It's gone.
That's right. No, I'm basically, look, I'm not disagreeing with a lot of what Mike is saying in terms of valuation. The question is the problem is when you're playing a game of musical chairs, everything is great as long as the music's playing. Right. The question is what causes the music to stop? Does it stop?
Right. Is it a power outage, or is it, the house burned down?
So what caused it to stop in the year 2000? Prices just went up too high and started ticking down. And then we got 9/11, which accelerated. But it's just when you go too high, the too high plateaus, the chart I showed you. I mean,
remember something about 2000 though, because it goes back to the same thing. Because of the idiocy of worrying about Y2K, Greenspan did a massive money pump in the end of 1999, which peaked and then took away the punch bowl in March. Stopped it in March. And of course, what happened? So March, there was a little bit of there was a pretty nasty correction in the NASDAQ stocks. Then they stopped, then they panicked and reversed course for a bit. You saw a rally through the summer, and then we got into the end of the year, and then
you had some pretty big fraud in there. You had Enron, you had WorldCom,
tons. There's so many things. There's so many cross currents. 9/11 obviously was the final, nail in the stake. I remember, going to Secaucus to our backup DR trading floor. I mean, I remember this, pretty carefully. The last week it was 9/11. I have very vivid memories of the towers falling. I have vivid memories of going into our disaster recovery site, which is where we set up our temporary trading floor because we were 10 blocks north of the towers and weren't allowed back because they were worried about asbestos poisoning and other sort of stuff. So, there were lots of cross currents back then. But still, if you really search through the noise, the two real drivers were what was going on the monetary side, where they panicked at Y2K and pumped too much. Then they kind of decided, whatever. It was just the driving was terrible. I mean, Greenspan. Bill Fleckenstein wrote a book about Greenspan that's probably worth everybody reading before you lionize him too much, because he basically deconstructs all of this crap. And that's what happened. And then, of course, the second driver was the real economy. And after 9/11, the real economy got the knee on the throat, and they didn't do anything on the monetary side, particularly for a little bit. And then once they did, what happened? And then you had the 2003 through 2006 run, and saw this happen to real estate, et cetera, et cetera. And we all know. And some of us, I was way too early on shorting the leveraged real estate market. I started in 2006. So yes, I feel your pain, Mike. I've been with you before, and I'll probably be with you again. Anyway, sorry for interrupting, but this obviously I lived that, so I know it pretty well.
Is it crazy that we didn't talk about Bitcoin basically, and it's 957? Is that how boring we are at 115, 116,000 here for Bitcoin? Or, 114.
I will tell you, if you look at the Bitcoin volatility chart, it's crazy. You know, it's still look at it. It's bopping along the bottom. I mean, when volatility returns, and it will be upside. Bitcoin, I've made this point before. Bitcoin's volatility is quite often driven by upside volatility, not just downside. Whereas the VIX is almost exclusively. I mean, it's huge correlation to downside only.
Yeah,
and so it's a very interesting.
The volumes are so.
Well, what makes sense?
Yeah.
So,
Well, but Dave, you just described a infant market that's maturing and potentially tilting the other way. Now we have the mainstream's in it, the ETF flows, everybody's in it. The correlations to the equity market are the highest ever, depending maybe 48 months, 4-year cycle, and that to me is part of the end game. And I view with there's a lot of competitors now, and Willy Woo not just Willy Woo, but Tom. Would point out that Tom Lee, that now to me it's just much more of a commodity, and obviously to me sometimes everything's a commodity, but in this case,
well, if it's a commodity, Mike, Mike, if it's a commodity that you can't increase the supply, that there's no way to do it, and the money supply continues to go up, then you have to be more bullish on Bitcoin than you are on other commodities, because all the other commodities we can produce it better.
There's certain times I was, and I pointed out in the chart, certainly in 2020 was at a significant discount, but now in 2025, it's at a significant premium with 21 million companions. I hope that's the right word that doesn't piss everybody off, but we're seeing that flow now. We're seeing.
Did you say that about stocks? I mean, seriously. I mean, all kidding aside, you say this all the time. What's the difference between saying that Fartcoin is a competitor to Bitcoin, and as I don't know, whatever, Joe's Bar and Grill, equity is a competitor to Google? I mean,
so let's talk about,
I don't understand the difference.
The key difference is, let's see the beef, let's see the test, and we haven't seen the test. My point is, but we're getting snippets of it. S&P 500 total returns 14%. First year of Trump administration, yeah, great. Bitcoin's up way underperforming of 25%, 22%. Gold's taken off, up 39%. To me, that's the potential beginning of, my job is to try to look ahead to those inflection points. And yes, oftentimes being early predicting the future. That's why I think this is what I'm seeing. It's just comparing the precious metals, but there's only 4, and some of the other banks are, spreading out a little bit away from gold. There's just so many competitors in cryptos, and they're all linked. Unfortunately, this morning I looked at Dogecoin again at 40 billion. I'm like, oh no, at some point I'm going to say it's going to be at 4,000, I think.
I think you might be disappointed when it doubles.
Yeah, I mean,
I would love to
all
be.
I'll say is this: if you look at gold versus silver,
one Musk tweet,
silver at least has some amount of precious metal. If you look at it versus platinum, and you look at it versus palladium, they have more industrial uses. I mean, this notion that meme coins are competitors to Bitcoin is just fabricated. The fact that they have coin in the name is the only thing that where it is. It's like Micromuse versus Microsoft. I mean, stocks are different. Yes, there's correlation among stocks, and there's correlation in stocks and Bitcoin and stocks and crypto also. But this notion, the only reason that notion of competitor is true is the same thing. If you look at what was the proximate cause for the bubble being pricked in 2000, the proximate cause was 2 things: was monetary supply, and there was this huge surge of people trying to IPO. Companies younger, 1 or 2 year old companies, the average, if you look at the time, the average age of companies, the average profitability of companies going to the IPO window dramatically dropped and dropped. And so, yeah, that was competition for new dollars. That's true. But that's true among all assets. I mean, and the 21 million is bullshit. You're just talking, most of that is pump.fund. I mean, there hasn't been more than 100 or 200 crypto assets that get any significant capital for quite some time. And I'd actually say it's probably more like 40 or 50. I mean, what do you think, James? I mean, may even be lower.
No, I mean, look, it's easy just to look at all of them and say that they're correlated. But the reality is that, Bitcoin marches ahead, and the thousands of other coins just benefit from capital coming into the space and from, a lot of people who are just speculating on trying to make more money than they can in Bitcoin. I mean, that's just, it's the only stable one in there, reality. And that's why when we talk about the market, we talk about drawdowns, we talk about risk assets, and this is the real thing. This is really what's most important for our listeners, is that I do expect that if the market has a drawdown, Bitcoin's going to have a steep drawdown too, and probably steeper than the general market. It's just a reality of a young asset that's being adopted. It's in its adoption phase. And so, but I also believe that it will recover slower but stronger than gold. And that's, so it just depends on your view on it and how much liquidity you need. And my advice to people has been, depending on the person, everybody's portfolio is not the same. So you have to look at your own portfolio. But for me, it's how much liquidity do you need? And if you don't need liquidity right away, then just hold tight. And I wouldn't sell all of it, because you're not going to be able to time that V-shaped recovery that I would expect in that kind of market drawdown. So
I know that
because of everything we talked about with the money bazooka. What's that?
I know that we need to go, but James, did you guys see what happened to Nakamoto today? If we were talking about treasury companies, we didn't. It's down 56% today, trading at $1.20. Wow. Saw somebody in the comments mentioned it, so I looked it up, thinking that I was being trolled. Yeah, yeah, what's 19? It was the first round, I think, was $1 or $2. The second round was $5, and this was trading at 20.
What's their MNAV, Scott?
Nobody knows. I tried to look it up. It was like at $2 or $3. It was like 130%. They've got to be trading at a discount now. There's only publicly like one purchase of Bitcoin, I think, but they've been buying Metaplanet and other things. So it's kind of, their MNAV is a bit foggy.
I would make the argument that it's probably not institutionally held, that it's all been retail, and that institutions don't know where to make of it. Because if you look at Gemini today, it's actually up 3%.
So what's beta in that space? MicroStrategy is trading 326. It's well below its 200-day moving average for first time in a couple of years. It's breaking down. You're supposed to sell it on rallies, and from a technical standpoint.
Well, I mean,
it needs to go to 100. Normal corrections go to 100.
We could do a whole. We could have a whole show of a conversation about MicroStrategy and Bitcoin treasury companies, but. Look, MicroStrategy is the leading Bitcoin treasury company right now. It's just reality, and it's going to trade at an MNAV, a multiple of the NAV of the Bitcoin underlying Bitcoin it holds on its balance sheet. And so the question is, where does that settle out? And I think long term it settles out somewhere between 1.5 and 2.5. And right now it's just under 1.5. So. I think that that's the bigger question. There's a whole discussion to be had about that, because it's much more complicated than just looking at how much Bitcoin they own on their balance sheet.
Wow. Yeah, it's that's I don't know if that's a harbinger or very unique to them, but people are going to pay attention to that. All right. Wow. Macro Monday. We did talk about Bitcoin for the last 10 minutes by going over time. So people can be happy about that. I know all three of you guys have got to go. Deeply appreciate it. As always, another incredible show. Talked a lot of macro. I think that was a nice breath of fresh air. We didn't argue about the same things. So good for us. All right, everybody. We will see you next week. Important reminder that apparently Starmer is a wanker. And we will see you guys soon. Thank you. Bye, guys.
Bye.
If your mobile number was stolen and your passwords were reset, would you even know it until it was too late? Your crypto wallets, exchanges, email, bank, cloud accounts, gone because someone took over your phone number and hijacked your two-factor authentication. This is called a SIM swap attack, and in the crypto world, it's one of the most devastating ways to get hacked. It's not rare. It happens every single day. That's why I've personally been a customer of Afani for years. In fact, I've been with them since before it was even called Afani, when I was the victim of a SIM swap SimSwap, and my friend Charlie Shrem introduced me to the CEO and founder Haseeb. I trusted them with my security first, and because I believed in it so much, I later became an investor in the company as well. Efani is built to stop SIM swaps, protect your privacy, and back you with $5 million in insurance just in case. They even include complimentary international data roaming so you can stay secure but also stay connected all around the world. Top crypto investors, traders, influencers, public figures, and financial institutions use Efani because one attack can be so costly. Efani is offering a discount for our community, and to learn more, go to efani.com/Scott Melker to get a secure mobile service with peace of mind. That's EFANI.com/SCOTTMELKER. You can also find the link in the description and show notes. In crypto, security isn't optional, it's survival.